Say what? Say EWC ARCA. So those are the iShares MSCI Canada ETF. I have absolutely no idea what that is, except that it's iShares, it's an ETF, and it's Canada. And does it really matter? Are you going to hold it against me that I don't know? It probably helps that I don't know what it is, so I don't have emotional bias. All I see is a super duper chart, Secretwars, Stan Weinstein analysis, and let's practice it, man. Right now, what I see, we had this nice stage 1, stage 2, stage 3, break below the cloud, stage 4. Look at that right here. See, here you could have thought it was a breakdown. It's a top, but you're above the 30-week moving average, so it's too early if you want to play it at the stand way. And after that, you could have thought there was another breakdown here. So for Stan's way, you were under a 30-week moving average, under horizontal breakdown line. Let's just see if the volume was cooperating. So yeah, you had these big candles for this volume. Did you have the RSI? Yeah, the RSI going from midway to bottom territory. That's awesome. So if I didn't have the that cloud, the Ichimoku cloud, telling me that I'm gonna run into some support, this would have been a beautiful triple confirmed Stan Weinstein stage 4. But now I have my Stan Weinstein quadruple confirmation for A++ setup is you don't want to have that cloud in the way. And see, that's another example where it just absorbed the price action. Doesn't mean the breakdown is going to not work out, but you're going to get that pullback. And this one was a little deep, was above that breakdown line. And down it went. So you put the chances on your side if you just wait for the break below the cloud. And it would have been this candle right here, this one. There's the pattern and candle breakdown. There's a nice pullback here on the slider volume, and then it just goes back down, up, down. So that's a stage 4. But what do we have here though? If you would have entered here on this breakdown, yeah, you would have been okay. Your sell stop would have been above that high here for traders, for investors. Traders stance says 4 to 6% above the breakdown line. I would do that, but I'd put it again, like Sana also says, above a round number. So maybe above this candle here. Price action went down, pull back. Price action went back down. So right here, you have your sell stop for your traders moved, investors here on top, and you would have both got triggered out. So I don't have a valid trend line, or do I? 1, 2, 3. So you would have been triggered out on that trend line. 1, 2, 3 here, right here. You would have taken your profits. So either if you would have entered on top here, this pattern, or this safer pattern here on this candle, you would have traded out a few months later for almost break even. For half of that position for traders and investors, and then you would have sold the rest when you break that 30-week moving average. Yeah, not a super duper start for stage 4. And you got to remember that, I know you could get on a roll and you have these nice stage 4s and stews and you're in, but you got to realize this happens and you can't do anything about it. This is dangerous territory. When the price action goes back up, it went back down, but you don't want to be there. What you want to do is, that's telling you that the price is going sideways. You don't want to get chopped. You sell. You draw your support line where the last tested. You send an alert at that support line, and you just wait. You wait until the price goes back down, and don't get greedy. Don't do any preemptive entry. Wait for that candle to really close below. So right here, this one here. How'd that volume look? So the volume is right here on that one. Not bad. Not twice as much as the previous 4 weeks, but a little bit. And the other side's going from halfway to negative territory. Triple confirmed? No, wait, quadruple confirmed, because we don't have any Ichimoku green support cloud under. So this stage 2 went a little bit better. This stage 4, sorry. Man, I dyslexia. So 1, 2, 3, 4, and you would have rode this all the way down. And this is the way you like it. The price action far away from the 30-week moving average. And when it decides to revert, you don't care because you have that trend line. And let's say, okay, you would have been here, right here on this one. Pullbacks. Is this one here? Here's one where you would have moved your sell stop. Traders, investors here. Traders right above this point. Above the 25, just so if it's exactly 25, always make sure you're on the other side of the round number. So 25.05. Price action goes back down. Sometimes when I'm confused here because of the candles, they're too close or too tight. You look at the RSI and then you see the U or the V, and you know that means there was a pullback in the price action. Here you could have moved your sell stop right here. Traders, investors, and another one here. Traders, investors, and then you have your trend line. Have your position here for traders and investors. So trend line violation, that means investors now start behaving like traders for their sell stops, and it would have used the sell stop of the trader right here and triggered out here. So not bad ride. Got a little choppy here, but if you were patient, you waited for that re-entry, you would have rode profits from here to, okay, here's half a position and the other half there, so a little bit in between. So that's your reward. Let me see that risk. That risk was, okay. Where would have put our sell stop? Here's a breakdown. Here's the top of the formation. And honestly, I feel comfortable, even if I be a trader, I like the sell stop above the 30-week moving average, above a round number for traders and investors. If you don't have a tight pattern that protects you, that's closer to the price action, but below 30-week moving average, when in doubt, this one's too far above the 30-week moving average. Anyways, you don't want to be there if the price action goes back down there. And good breakouts, they shouldn't pull back more than forget the 46% there within the boundaries of the breakdown. So that's how you could play it safe. You could be tempted to try to skew the risk to rewards in your favor by increasing your position size by having a stop very close. But I'd rather have less risk reward, have a higher probability of staying in the trade and going to my target. And just worst case, just open the trade on another stock and just make sure you don't get whipsawed out. That's my two errors I used to do the most. As I wouldn't wait for the weekly close or monthly close, whatever time frame I was playing. It looked so good. I was so deep inside and like over the breakout line, and bam, in 2 days the market, whew, it just sucked up the price and it closed on the wrong side of that breakdown line. And I just had a long wick out of it, and that's like, it's just what I call noise. And after that, I was trapped. So you don't want to be that. You don't do that. And I used to do the mistake of always lowering my sell stops to try to have a bigger position size, to have a bigger risk to reward, and I'd get whipsawed with that too. So those are two mistakes that I've eliminated or try not to do anymore. So even if this is my risk and my reward is, see, about 1.5, it's good. If 80% of the time, look, even if you have a reward of 1 on the trade, so you risk 1 to win 1. If you have 50% of the time, if you have a 50% ratio of having that, then you break even. If you have 55 or 60, you're in the money. Stand system, and if you've seen it through me from all this practice, and you could go through it, it's like more 75 or 80% that you'll be in the green, because you're moving those sell stops aggressively. You always protect the sell stops. You're protected from the whipsaws because it's put at strategic areas below 30-week moving average, below pullbacks that have corrected. So even if you have a risk to reward of 1 to 1, so when you start putting that sell stop at the beginning, your stop loss, and you try to get greedy, my risk reward is not good. Let me shrink that here, and then I'll have a 4-to-1 risk reward ratio up. You don't have to with stance. You can do that with low probability frameworks where, let's say you're doing, I don't know, Fibonacci, just classical, let's say classical charting, and you're not too good at it, or you're on a shorter time frame and you get whipsawed a lot because of intraday. On those lower time frames, your probability of reaching possible targets are a lot lower than on the monthly time frame. So on those, you can always have to go for the Hail Marys on the smaller time frame because of the whipsaw action, the intraday action, and then you have to seek those higher risk to reward, or else you're just not gonna. It's not gonna pan out for you. Your risk and money management, just the math of it is not gonna make you be positive. But when you have a 75% probability of being positive, of being in the green, then a risk reward of 1 to 1 is good. I would never spit on that. If I had 80% possibilities, that's money in the bank. Don't get greedy. All right. That's a lesson for me. I'm speaking out loud to you guys, but it's mostly for my thought process to really register those neurons. Hearing myself talk really helps. And I've noticed also that over years after that, once you've patched up your framework from whatever mentors or whatever influencers you read out there, you start becoming focused more on the charts and applying that framework, which is really defined in your head, and you don't roam around, you don't try too many crazy stuff at the same time. You're really precise. Your heart doesn't race when you enter a trade because the rewards, I'll be a millionaire. That's out the window. You're really just there to reapply your framework as best as you can. And you'll get that feeling eventually if you don't have it now, and it just takes time and practice. All right, enough talking, Patrick. So that's a nice stage 2. And let's get back here. And after that, price action went back up. You could have had some breakout here's, but you don't want to do it because You're below that red cloud. You want to wait for your breakout, like this maybe here. It's a breakout. Look, this is the candle. Right here, breakout candle. Here it doesn't count the volume. It's the previous 4 to 5 weeks average. So 1, 2, 3, 4. Yeah, maybe twice, maybe 30% more. And look, it's a nice bottom, nice. I don't know what you call that. Head and shoulders bottom, maybe left shoulder, spike, right shoulder. So already there, you had the swing rule for stand, and or else you just had the, which it never reached. Or else you just had the breakout, which really didn't take off right away. Your sell stop would have been originally, see, now the pattern is really above 30-week moving average. Investors and traders, I guess you could have put it here, or at least traders and investors would have put it below. So traders here, you don't have to protect yourself 30-week moving average. You have that pattern protecting you. Sideways, not super. Bounce off the 30-week moving average. Pull back, go up. Then you could move your sell stops here for traders and investors. Traders, you might have decided just to pull the plug right there. You could have said, "Oh, it's not going my way." And I think traders, you have to pull out on any 30-week moving average violation. And investors, it's at your discretion, but you need you want to see the price action goes the 30-week moving average going at a better angle up. And it's all signs. Don't force it. Like I said, get triggered out and just wait until either you're going back in a little higher, or you just go to another A+ stock setup. If you have these stocks that don't skyrocket, then and the stage 2 is not at a steep angle, not a stage 3, but you have chances of getting whipsawed there, where the price action always goes back down below 30-week moving average. And you don't want to risk being here under a 30-week moving average, and then you could just drop off the cliff. You don't want to hang in there. This is like stressful nights for a potential gain. It doesn't make sense. You want to be there when it drops solid like this. That's what you want. So there's still choppy waters, stop, chase, shoot, and that's where I am today. And look at that cloud starting to thin out, and we're approaching breakdown territory, stage 4. So right now it's in a stage 3. 3-week moving average is flat. Price action has gone closer to 3-week moving average, under, pulling it down. The Ichimoku cloud is wearing thin, and we could have a breakdown any moment now. Let me set my alerts. Okay, in case of a upward scenario, which we're far off for now, and put it, stop, an alert here, maybe another alert here. Hey, they're free, just to come back to the chart in case it starts moving laterally for a little while. So breakdown below 27 at this stage, especially maybe next candle, we'll be out of the green. 27.50, 26.50 close with good volume, and this is a short. You're gonna want to have good volume on that breakdown candle if it's gonna be that case, and you're gonna want to be from your midway points going to negative territory or below 50 on the RSI. And I think we're set, guys. Okay, EWC. You're a strong stage 4 candidate. You're on the watch list. Ciao.